Hello, and thanks for joining me, Phil Spencer, for the latest in this series looking at all things remortgaging. Remortgaging has indeed become a bit of a hot topic since the recent interest rate rises. Why? Well, Bank of England interest rates are at a 14-year high at the moment. The base rate rose to 3.5% in December, and it's predicted to reach 4.5% by July this year. Now that might not sound a lot, but I'm going to be explaining how even half a percentage interest rate rise could cost you thousands of pounds over the next couple of years. That is a big incentive for many people to look around for the best current deals. And of course, these are changing all the time. Whether you're entering the mortgage maze for the first time or remortgaging, now more than ever, it makes sense to work with a mortgage broker. They can calculate how much the various mortgage products will cost and root out the best deals specifically for you. Our partnered mortgage experts have a 5-star Trustpilot rating from over 5,000 reviews, and there's a link in the description where you can connect with them to get you started. It's estimated that 3/4 of mortgage holders are on fixed rates, and if you're one of them, an interest rate rise will make no difference to you for now. But fixed rate mortgages only last a certain amount of time, usually between 2 and 10 years. And when your fixed rate does end, you'll join the estimated 2 million people who are said to be on their lender's standard variable rate, generally known as the SVR. And that changes when the Bank of England puts up its own base rate. To put this in some kind of context, if you had a £200,000 interest-only mortgage over 20 years at an interest rate of 2.49%, you'd have been paying £415 a month. If your fixed rate deal ended in December 2022 and you moved to your lender's SVR of 5.75%, your payments would have shot up and your repayments would have more than doubled. Understandably, there's been huge demand from people looking for a new fixed-rate mortgage if their existing one is due to run out. But of course, the new fixed-rate mortgages reflect the new interest rates, so these have also gone up significantly. If the base rate does go as high as predicted, fixed-rate mortgages could rise to 6% or more. What does that mean for you? Well, let's look at what happened at the end of last year when interest rates went up from 3% to 3.5%. If you had a £100,000 mortgage on a variable rate, your monthly payments at that point went up £42 a month. Over 2 years, that would cost you an extra £1,008. But the average mortgage debt is closer to £150,000, and on that size of loan, repayments would have cost £63 a month more. That is another £1,488 over the 2 years, and an extra £3,700 over the next 5 years. I hope that does help to put some sort of flesh on the bones and some context around the numbers. To take it a little bit further, on a £350,000 mortgage, you're looking at eye-watering £8,700 more in repayments over the next 5 years. So it's kind of big news. Each 0.5% makes a huge difference. And as I said at the start, interest rates could go up another whole percentage point this year. I will be keeping a close eye on developments over the coming months. So do please make sure you subscribe and hit the alert bell. See you next time. Good luck. Please do remember that your property may be repossessed. If you do not keep up repayments on your mortgage, you may have to pay an early repayment charge to your existing lender if you remortgage, and individual savings may vary. Your savings will depend on personal circumstances.